We'd like to welcome you to today's session from Talking Hedge Events. I would like to turn things over to the president and founder of Talking Hedge Events, Meg Bodie. Meg, take it away.
Terrific. Thank you so much, Ken. And hello, everybody. Happy Friday again, and welcome to the third webinar in our Toronto series. Once again, sorry we can't be there. Hoping that you'll open the borders, that this Delta variant gets taken out by next summer, and that we can revisit all of our friends up in Toronto. But in the meantime, I hope you're all well and safe and enjoying summer. We have an amazing discussion here today. Commodities are kind of on fire. The concept of investing in them, people are taking wide-eyed look right now at what's going on, and we're going to tell you all about it. And we'll get moving with that in a few minutes. As I always say, the comments and opinions expressed today by our speakers are their own, not necessarily reflective of their firm's opinions. So please bear that in mind. And I certainly want to thank Auspice Capital for coming to us and wanting to do this topic with us. It's a fantastic one. We have had a huge response to it. We have a very large audience today, several countries represented, and we're very excited always excited to broaden our footprint, which is really, really terrific. So thank you to Auspice and to our other sponsors, Lixor and Efficient and InfraHedge, and to Alphadence and Bodie Research up there in Toronto, and Crable Capital and FAR Capital and O'Brien Investment Group, who will be with us next week on a crypto topic, and Strix Leviathan, also crypto, and Unigestion, who will be with us in August, talking about macro and CTA strategies. So I'd also just like to give a very big nod to our association partners. I'm so proud to partner with AMA and CASA and Kaya and thank them for helping us spread the word. Okay, let's get into it. Herman, why don't you turn on your video? Stephen, Mark, Timmer,
Meg.
Come on. And I'm going to let you guys take it away. Have a very lively session.
Thanks, Meg. Appreciate that. Well, welcome everyone this morning. I think it's an incredibly timely and topical subject, and probably top of mind for many of investors, and especially those, that have been underinvested for the last 10 years or so. And it's just incredibly interesting in terms of where we are in the cycle and the effects that COVID and quarantine has had on things like supply and demand and so forth. Anyway, welcome to Talking Hedges, investing in the new commodities supercycle. A generational demand shock meets a decade of underinvestment. Throughout the first half of the year, commodity markets, obviously, as Meg just mentioned, being caught up in this in incredible rallies and the expectation of a commodity supercycle, and the likes of Goldman Sachs, for example, predicting a commodity supercycle equivalent to that of the late 19th century on post-Second World War reconstruction and so forth. Anyway, I'm Herman Lorette. I run the Global Macro CTA Quant and Multi-Strategy team at Titan Advisors, which is a $4.5 billion fund-to-fund out of Stamford in Connecticut. I just want to just mention we have a great lineup of speakers today. So I'm just going to briefly introduce them and then have each one of them talk a little bit about what they do and introduce themselves as well. So we've got Tim Pickering, who's the founder and chief investment officer of Auspice Capital Advisors. We've got Steve Wilson, who's the director of stable value hedge funds and the All Country World Index Beta 1 from the Teacher Retirement System of Texas. And lastly, we've got Mark Raskopf, who's a portfolio manager and the head of tactical trading strategies at Russell Investments. So just before I introduce, have each one of them talk briefly about themselves, Tim Pickering is going to walk us through a few slides and talk about the backdrop for today's panel. And then we'll open up the discussion to questions. Please feel free to ask questions. We'll try and get to them as quickly as we can. But we want to make this a lively discussion. and make it worthwhile for everyone here. It's hopefully going to be educational, and hopefully everyone's going to come away from this feeling more informed about the commodities market and the outlook for the for the space. So why don't we start with you, Tim, if you'll introduce yourself and talk a little bit about what you do.
Yeah, that's great. Thank you, Herman, and appreciate you stepping in your role here. And yeah, I'm honored to be on this webinar with these gentlemen. We've had a lot of chance to talk about this topic, and we're all pretty excited about it. I'm going to roll through a couple slides, but I'll give you a little bit of background. This will just take a couple minutes. I started trading commodities in 1996 after finishing the trading development program at Toronto Dominion Bank in Toronto. I went there after undergrad. Commodities were part of the prop desk, a proprietary desk at TD, where we could trade anything. And at the time, if you think 95, 96, when I started on the program, it was the dot-com boom, and people literally thought I was throwing away my career. Commodities seemed a pretty old school thing. However, we knew the value of the opportunity. It came from the massive diversity of the sector. There's no investable sector, in my view, with the diversity of commodities. Cotton is not like crude, is not like coffee, is not like canola. And when I was asked how I was going to approach this, the answer was quite simple, and it's risk one to make three. It's systematic discipline, and that made the most sense to me, and that has never changed for us, never changed for me and my trading partner. Energies were very happening at the time. If you think of the late 90s, I left TD Bank to join Shell and ran that in Calgary and then Houston, Texas for 5 years before starting Auspice 15 years ago with my trading partner now of over 20 years, Ken Corner, who co-founded this firm with me. I'm going to run through a couple slides. I guess there's 5 of them, just very quickly to set the stage, and then we're going to dive into these topics. First one is just showing rolling 10-year annualized returns that, like equities on the right, commodities cycle. This isn't a big surprise, but they're generally very long-term cycles. And we've been at the bottom of this for about 5 years after peaking around 10 years ago. So just really fodder for thought in terms of where we are in this. And, are we halfway through? Are we, near the top? No, we're near the bottom, and we've been there a long time. If I flip to the next slide, this is showing it another way, and that is the ratio of the GSCI commodity index and the S&P. I started my career, as I mentioned, at that dot-com bubble that shows up in the late 90s, near the bottom the last time. And all I can say is, had I known then what I know now, would have been even a lot more exciting. I'd say I was a little bit young and naive. If we flip to the next slide, this is probably one of the reasons we get really, really excited looking at the chart on the left. Here's what I would say is recency bias has really led to commodities being shunned. And this is partially conflated by the misuse of linear arithmetic charting that pretty much everybody uses for short to medium. When you look at things, and the scaling here is for really most appropriate linear charting for short and medium term, but not long term. The appropriate view is really taking that same data with logarithmic scaling or proportional scaling, which we've used on the left. And few investors, what this tells you is that few investors realize commodities until recently have consistently outperformed equities, as you see on the left. Perhaps the recent performance, the last 10 years until this past year, which we're going to talk about, is really the anomaly, maybe. On the right, we've got 2 commodity index. One's passive long only, the Bloomberg Commodity Index, and the other is an active long flat index, the Auspice Broad Commodity Index, which is published on NYSE, and that shows that they're breaking out. So again, just fodder for thought on these topics. And then the next slide really kind of says, why commodities? Why are we even having this discussion? Here's what I'd say. Commodities accomplish a lot. Not only inflation protection, which we're going to talk about, portfolio diversification given the low correlation to other assets, the alpha generation opportunities for experienced managers. But it's kind of this last one. It's the green transition that is a bullish commodity factor. And it's this concept that, there's no build back better without commodities. If anybody's interested, we have a video on this exact topic, 2-minute video right on our website, just to get in a quick plug. And then lastly, it transitions to this topic, the green transition in the last slide here. As we rolled out of 2019 into 2020, pre-COVID, pre the idea of a global unification towards a greening of the economy, one of the biggest calls out there was bullish commodities. It's already been mentioned by Herman, in terms of the view out of groups like Goldman. This came from a number of sources. Why? People recognized as we came into 2020, there was a massive infrastructure gap looming, upwards of 15 trillion. Mark's likely going to have something to say about this. He's got some great data points. We now recognize there's basically two ingredients for a commodity supercycle. One, an extended period of underinvestment in supply. We've got that. This is an area that was shunned, avoided, ignored for a long time. And the second thing is a generational demand shock. And we argue today we have both of these things. Now what's happened is the consultants and everybody's kind of waking up and recognizing that there is no greening of the economy, or as Mercer points out, a pathway to a climate neutral world without commodities. And even if you look at the picture in this slide, the amount of concrete and steel and metals used to even put up a turbine field is massive. And so with that, this kind of sets the stage. We're going to dive into these topics. Thanks for joining us, and let's get into it.
Great. Mark, if you'd just quickly talk a little bit about what you do at Russell, and then Stephen, you want to just follow right after? Is that good?
Sure. Thanks, Herman. So Russell's an 85-year-old firm in the customized OCIO space. We're about 300 million all in, and I focus on both managing the long-only BCOM commodity benchmark portfolios, and I also sit on the hedge fund team, where I research systematic and discretionary macro hedge funds, commodity-focused hedge funds, and quantitative equity hedge funds. And I've been doing research on hedge funds and other active strategies for about 26 years. That's it for me.
Yep, I'm Stephen Wilson. I'm a director here at Teacher Retirement System of Texas. We're a $195 billion public pension that services the 1.7 million teachers in the state of Texas. And my particular role is I run the stable value hedge fund portfolio, which is approximately $10 billion and invests in a very wide range of strategies. CTAs, macro, equity market neutral, reinsurance, platforms, you name it. We're basically looking for anything that's diversifying and alpha productive and does not take material systematic risk. So yeah, that's my role, and happy to be here today.
Great, thanks everyone. So maybe we just start off by asking. I'd love to just get each one of your opinions in terms of, what do you think are the three main reasons for the bull case for commodities here currently? Maybe start with you, Stephen, since you went last.
Yeah, I'm in a very nice position that I don't have to figure out the directionality of which way commodities is going. At TRS, we don't actually have long commodities in our asset allocation. We have allocations to energy, natural resources, infrastructure, which is a lot of private investments that are in the commodity linked space. But we don't say, well, we're going to have 2% in oil or anything like that. For me, what's more exciting is the breadth and decorrelation of the commodity asset class. If you just look kind of what Tim was saying, coffee is not, oil is not, whatever. We just find that that there's not a lot of people trading this stuff anymore because of reasons that we can discuss later about, the hedge fund industry and commodities over the last decade. So it's just easier for folks to make money now. Contracts remain uncorrelated. And then the other nice thing is that they can be very volatile, which allows people to express risk without levering up, right? And so we've been very purposeful in trying to find the best way to access these types of return streams, because there's certain ways that don't work, in my view, but there's certain ways that do. And so for us, the attraction is really, that if you're getting into a commodity product, you're probably starting off from a non-crowded, alpha productive, diversifying standpoint, and then you just got to find the right partner.
Yeah, and just briefly, how large would you say is your allocation currently versus, say, a year ago, just to give a sense of your conviction in the asset class?
Yeah, that's a good question. We pick it up in a lot of our systematic macro managers, so it can change depending on signal strength and stuff like that. But a year ago, we probably had 500 to 600 million in it. I'd say today we've got over $1 billion in it now. It's been an increase for us over recent years because we've gotten more access points for a larger number of markets.
Interesting, great. So Mark, I know that you've done a ton of research in the space, and I know you've thrown out a ton of numbers on infrastructure and things of that nature. Like, where do you guys stand with your investor base? What do the incoming calls sound like? Are they more frequent? How much of your time now versus, say, a year ago is spent on commodities?
It's definitely picked up. I'm spending a lot more time on the hedge fund side, on the research side of hedge funds. And in the hedge fund portfolios, the commodity strategies have probably tripled in the past 18 to 24 months. On the long only side, it's a little slower. I think it is picking up. We're beginning to speak to a lot of our big clients and making recommendations for, coming off of underweight to sort of neutral or overweight. It's a little bit of a broken record. But I did want to address your other question, which was, do we think there's, what are the reasons for expecting a long-term bull market in commodities? And I just want to jump on that if you guys don't mind.
Sure.
So we've been doing this a lot internally, Russell, and where I come out is definitely yes. I think we're getting into this new phase of commodity demand, driven largely both, by aging infrastructure and combating climate change. The infrastructure is nothing new; it's just necessary evil. But the social acceptance of the need to focus on climate neutrality has really picked up in the past, call it 12 to 18 months. And at Russell, focusing on ESG, we've seen a lot of interest and demand from clients on, where we come out on ESG. And where I think the rubber hits the road is, by definition, more eyeballs are sorting through everyone's business, frankly. And this highlights which public companies are taking this seriously and which aren't. And this puts a lot of emphasis on this kind of farm to fork concept for everything that we do, or people call it ethical sourcing. And last week, we all saw these headlines by OFAC that the U.S. is cracking down on American firms that don't check for supply chains that are tainted by certain things, human rights abuses, and so on. And I don't know how you guys are seeing this, but this is how I think the trend starts. There's so many new jobs in ESG. Frankly, a lot of people are learning as they go. But this ethical sourcing will also focus on how green your global production and supply chains are. One last thing about ESG, I think this really hits home, is while ESG is essentially asking us to limit spare capacity by cutting spending and so on, ESG doesn't sort of conveniently, it doesn't have a detailed or prescriptive view on how to get to lower demand. And that's creating this major opportunity for active investors. I think Steve's capitalizing on that. And all of this ESG focus is happening at the same time as less investment in energy. JP Morgan came out with a report a couple of weeks ago that it's something like the top 45 energy companies, Aramco, are about 600 billion short of CapEx spending to replace reserves, right? So that's quite interesting. And I just want to say one more quick thing. This is the kind of investor and political demand for change. Something like 68% of global GDPs voted for net zero by 2050 or 60. And that demand for change, I think, fuels each of the individual underlying projects that are necessary to bring about this change. And even Axios today reported that Jigar Shah, who heads the DOE's loan program office, he wants to go from 200 billion to $1 trillion a year to achieve U.S.'s climate goals. So that's going to be loan guarantees for new projects across advanced nuclear, carbon storage, EV and battery manufacturing, critical mineral sourcing and extraction, and all that. So what's happening is that in order to get to climate neutrality, you need to change the way lots of industry is powered. And you need to change what kind of cars you drive, what kind of fuel is burned in international shipping, and so on. But here's another interesting thing. I think it's worth thinking about. If you ask folks how much extra they want to spend to be part of this transition, it's a very low amount. I'm sure you've seen polls like that. So we're talking about the government needing to incentivize change without disrupting the economy. And that means some pretty large government-sponsored projects, including the DOE's loan program that we talked about. So I think I'd like to ask everyone to consider whether each individual can fully understand exactly what needs to happen to slow greenhouse gas emissions, for example. Frankly, I can't even do it. It's just too much because the size and number of projects is so big. Mm-hmm. And this is why Shaw says the pace at which climate solutions are being deployed is unacceptable. And most of the economists that I speak with at these discretionary macro funds believe that the net result of this complexity, the challenge, is that we'll continue to see the government's influence increase over time in order to affect change. And that's how it works. People are voting for reps who will push to limit climate change, and that turns into more government control. We see that in our bond market, obviously, and the punchline is that there'll be lots of demand for commodities to build all this stuff. And I've got a ton of data, but I'll wait for later on that.
Mark, sorry to interject it quickly. I got a great question that just came in from one of the attendees here. And, he's hearing that a lot of people are putting ESG filters on investment selection, and commodities don't screen well, and therefore they can't invest into them. How do you think the ESG filtering will affect the demand and appetite levels?
Well, I think Steve's got some stories on that. And maybe Tim, in our pre-call chat, Tim's got some comments there. I mean, we've seen everything across the board from people saying, absolutely don't want anything associated with energy in any of our portfolios. I think the vast majority of folks are a little less, they will allow some certain energy investments. We haven't seen our long only commodities business decline specifically from people exiting it out of their policy portfolios, but it's definitely a conversation, and there's definitely a conversation around how to access it, whether you can do it through equities where you can be an active owner and influence management, or if you can tackle it through financial futures, and it's still an ongoing discussion.
Got it. Thanks. So Tim, let's move on to you. Tim runs a hugely successful CTA and is one of the very few commodity CTAs out there. Tim, I'd love to get your thoughts on that as well, but specifically, maybe you can enlighten the crowd here. Do you have an ESG fund as well? And if that's the case, or are you probably thinking about it, how do you get around that idea that you can't invest in commodities?
ESG, look, as Mark was saying and Steve's mentioned, ESG is a big topic. You can't get away from it. So ESG is part of what we do here at Auspice, and I think policy, has to be evolving and keep up with things. Having said that, we can only speak to our own, expertise, and the way we look at it is this: we're a quantitative CTA manager. We're agnostic. We don't take company risk. We trade the underlying, and we're agnostic whether we're long or short. And so, at the end of the day, from that perspective, we are neutral. And we look at the benefits of trading in that way to the marketplace, liquidity, transfer risk, and all those things. And those are good things. Having said that, as Mark alluded to, we have encountered some, clients that just said, look, if you're in fossil fuels, whether you're long or short, it doesn't fit our criteria. Look, if people want to take that hard line, that's their own decision, and we respect that, and we're not for everybody. But also to what Mark said, in terms of this greening of everything, and some of the comments that being made, one of them I noted was Larry Fink from BlackRock, basically said that if our solution is to go to an entirely green world, we're going to have much higher inflation because we don't have the technology to get there yet. That's a big policy related thing. And are we willing to be able to accept more inflation as we accelerate this green footprint? And so then it comes back to your original question is like, well, why commodities? If you're going to hang your hat on gold being that inflation protection, it's really disappointed in the last year. Is it going to be oil? Well, it may be at times for sure, but you have to look far more widespread than that. We think there's a far better way to do that, looking widespread agnostically at the commodity landscape and say we're willing to go with what the market gives us. If it's cotton that wants to move higher, if it's this, if it's that, we're agnostic as to where that's going to come from. And we believe that's the best way for clients to protect themselves from an inflationary environment, which links back to this whole greening, ESG. All these topics are intertwined.
And that's great. And you touched on a topic that I'd love to ask Stephen next on, which is maybe you can talk about briefly how you access commodities, and is it through infrastructure? Is it through hedge funds? Is it through commodities directly? It sounds like obviously you don't have beta; it's more alpha. It sounds like. And if it's hedge funds, do you invest primarily in specialists? So, for example, metal specialists or grains, ags, and so forth.
Yeah, actually, I have a lot more to say about this than inflation, so I'm glad you kind of switched gears.
Okay, good.
Well, Texas Teachers, like I said, we do have private investments in, sort of commodity, banging things, all sorts of stuff related, things that you would say have beta or systematic risk or whatever. Like it is sort of a, if oil goes up, that we make money, right? In my portfolio, I'm more focused on accessing it as an uncorrelated trading asset class more than anything else. And, our approach has evolved over the years. Circa 2013, there was a whole lot more people out there doing discretionary commodity trading. I mean, it was basically just global macro only in commodities. That's how we kind of thought about it. And, I think the environment pre-financial crisis made a lot of those folks look like they had a lot of skill, whereas a lot of it was much more dependent on just timing the cycle right that Tim showed earlier. And some strategies work really well in certain parts of the cycle and some don't. We're not really in the business of saying, I'm going to say where we are in the cycle and I'm going to pick a strategy that's going to do well in that part of the cycle. I mean, if I could tell you where we were in the cycle, I'd go run my own hedge fund and make a whole lot more money than a government worker here, right? So what we're looking for is things that are resilient through various market cycles in commodities. And again, the asset class remains highly attractive because of its decorrelation and lack of crowdedness. So what we've emphasized is generating a very wide breadth. So we try and have every market we possibly can. It's very easy to get access to liquid futures. We've gone into less liquid futures and over the counter. We recently made a big push into onshore Chinese equities. All of that is to try and get as much breadth as we possibly can, because like we said, the correlation matrix between all these things is everything is just so decorrelated. Now, there were a lot of specialists, and you could probably still go find some specialists, but, kind of what Tim was saying earlier, corn is not, terephthalic acid, which is not oil, which is not coffee, right? And it's really hard to be an expert in all of those things. So if I'm looking for breadth, I've got to find a fund out there that's got the best coffee guy and the best corn guy and the best whatever. And that just doesn't really exist. I mean, there's a couple of firms that are trying to do that, but that is really hard to do from a fundamental asset selection perspective. So what does that leave? Systematic. Almost 95% of our exposure is systematic, because you can cover a lot of different markets. You can cover loads of different markets, which, like I said, is what you're looking for. And you don't have to go spend a bunch of money hiring the best person in metals. So we didn't always have it this way. I mean, we kind of got our hands burned a little bit back in the 2013, 2014 era. And then we sort of said, well, let's really think about the right way to approach this. And we sort of said, systematic's the way to go. Get as many markets as you can. And that's actually been very successful for us. I mean, a lot of people were kind of telling us we're crazy for staying in commodities, but it's really worked out.
So I want to add to that. I mean, I agree 100% from a systematic perspective. That's our approach, as I mentioned. But one of the interesting things, you talk about a specialist. I mean, I think when we started out at Auspice, we were kind of pigeonholed as energy guys because we came out of Shell. And in a way, we were focused a lot on the energy markets, very volatile, great trends, all those opportunities. But probably the biggest takeaway I explained to people from that is you learned a lot about risk management and trading in the energy space. When you start as a base case in natural gas, you learn to respect risk if you're going to survive. And that basis really formed a strong foundation for everything we expanded into. We said, we can adapt to volatility and the volatility regimes of natural gas going from 30 to 130 vol. Does that same adaptability and agility apply to all commodities? And the answer is yes. And so, I think the specialist idea, it's hard to find specialists, but oftentimes when you do find the specialists, they've learned something really, really specific about risk in those key areas. Energy is a great proving ground.
Great. So Tim, thank you for that. Mark, with respect to your investing in commodities, how do you approach it from the hedge fund side? Do you go through specialists or systematic like Stephen? Maybe you can just give a sort of a flavor in terms of where you're leaning at this point, and maybe also just touch on for the folks here attending, what do you think of the pitfalls that people should be thinking about when investing in the space?
Okay, pitfalls. That's an easy one. I think size, depending on what you're trading. We kind of remember what happened in natural gas the last time around. If you go down to Houston, there used to be several, hedge funds with north of $1 billion trading natural gas, and I'm pretty sure none of them are around anymore. But so size, it hurts us effectively, and we are, painfully aware of that across our portfolios. But so how do we attack on the hedge fund side? We do a combination of systematic and discretionary. We're about half systematic, call it. So we do some trend following. We sort of did a bit of a rifle shot on some alternative, people call them alternative commodity futures. These are basically the smaller markets. Again, you got to be a smaller manager to access that. We have a manager that traffics in Chinese commodities that has done fabulously well for us, knock on wood. On the discretionary side, we do have some capital with more generalist commodity managers, but I think we have a heavier weight towards specialists. We have made allocations to, straight natural gas traders, I guess, specifically because we feel like there's it's less crowded at this point. And again, we've been very well rewarded for that. I think that's one of the themes that we do as a team pretty well, is we look for sort of the cycles in how excited the investing public is on something, and we kind of go the other way. We're smaller, I think, than some of the big hedge fund, portfolios like Steve. So we can, make some of these smaller managers, I'm talking about $250 to $500 million managers. We can make an allocation to them and have it be meaningful for some of our portfolios. I think that's a little bit unique. So that's how we do it. Did that answer the questions? I can't remember how many.
Yeah, no, that's perfect. So Tim, for you as a CTA, I'm just curious, has life become easier or harder for the models to get long or short, just given the amount of commodities that are now in backwardation, i.e. the deferred contracts are lower than the front contracts, meaning you can go out a year and own it and pick up a lot of carry by just owning it if the front stays the same price. Alternatively, there are fewer contracts in contango, which means that the deferred price is higher than the front price. And I'm just curious, you as a CTA and your models, are more of your models leaning long because the carry, if you will, is more positive now than it has been in a long time?
That's a great question. So the quick answer is we're not more long because of that. We make a decision to be long based on physics, right? It's momentum and trend. And then we make a decision, where do we want to be on the forward term structure of futures contracts? That is a quantitative decision. That's a process we developed, back at Shell that we've overlaid on everything we trade. Obviously, it's more relevant in things with term structure like the energies and grains versus, say, gold. But they're kind of two separate decisions. And you could even run that term structure overlay and be profitable as a standalone. And so, the quick answer is there's a few tailwinds that have come about in the last year. Yes, commodities have become more relevant. Long trends behave a little bit different than short trends. Having said that, we've seen, violent moves in both ways, up and down, in the last year. Think of at the end of March with crude going to negative last year in 2020. And at the end of the day, one of the things I want people to take away is that as a CTA, I'm agnostic. I don't care, which commodity, and I don't care which way it's going in general. They do behave differently, a little bit, but you have to be adept at both. And, I've often joked with people, maybe it's a little easier with these longer, slow moving up moves, long trades. But I think we're actually a better short trader because we had to learn how to capture those opportunities that happen very quickly. It's like escalator up, elevator down. And how do you define your risk and how do you take that risk off to capture that very quick, short move? We had to be very adept at that, coming out of the energy space and have taken that same principle across all assets. And, there's some tailwinds. The backwardation is one of them. The interest in the sector is one of them. The long side has been one of them. But I'll make this clear. Like, let's just say this story unfolds, inflation, commodities moving higher, and everything we're talking about. But it's not going to be a straight line in general. Let's say commodities as a proxy drop 50% over the next 6 months. I'm just as happy to go short, and we will. We're completely agnostic. And we're not going to marry anything. We're not the type of group that bought natural gas at, $4 and it drops to $3. Well, we buy more because we like it more. This isn't a value play. This is quantitative investing, and we're agnostic. And our job is to provide non-correlated returns for our clients. It's as simple as that. And the way we accomplish that is that diverse commodity sector.
Right. Ken, just before I move on to Stephen for the next question, would you mind showing the results of the poll? I believe they came in. Thank you. Okay. So a lot of fund managers followed by investors. Looks like we've got the outlook. Active commodity strategies, very appropriately, is top of mind in terms of the best 5 to 7 year outlook. So I think that tells us a little bit about how people are thinking about commodities from a time frame perspective. Let's see, return expectation for active commodity managers higher than the last decade. I think most of us would concur with that, just given the dynamics and dispersion and so forth. Currently investing in next 12 months or already invested. Interesting. Not applicable. When added to your hedge fund alts portfolio, 12% annualized return, negative correlation. Very interesting. Yeah. So any of the panelists have any particular comments on these results from the poll?
One that grabs me is question 6, and that is the hedge fund or alts portfolio, what profile is more attractive, and recognizing that 4 to 12% with a negative correlation is more valuable to a portfolio. Minus 0.2 is a lot more accretive to a portfolio than plus 0.2. And so recognizing that is to me is impactful. It's great to see people recognizing that.
Great. So, Stephen, maybe I'm going to come back to you on the inflation part. I'm sorry to do this to you. But it did say that commodities is one of the best inflation hedges. And I'm just thinking about from a pensions perspective, and certainly from our investor base, we get a lot of questions from pensions who have been underinvested in the space and are now concerned about their portfolio being somewhat susceptible to inflation. And arguably inflation's already here if you look at CPI on a year-over-year basis. But on a look forward basis, when we think about things like, owner's equivalent rent and wages potentially picking up and creating that more sticky CPI, are you, is Texas Teachers Pension Fund concerned about inflation, and is the commodity sector a potential hedge for you in that regard?
Yes.
I know that you're more systematic and so forth, but sort of the high level, how do you guys think about commodities as a potential inflation hedge?
Yeah, I mean, yes, we're concerned with it. I think it's, there's all sorts of charts that show the number of mentions and board minutes and like whatever call like gone through the roof in the last 12 months. I mean, inflation is the topic du jour, so we can't afford to not be concerned about it. We're more likely to make changes to our strategic asset allocation incrementally that we think will help guard against the increased likelihood of that scenario. So moving more money into energy, natural resources, and infrastructure out of treasuries, things like that, then we're more likely to do something like that. Because look, we may not have a commodity super cycle boom, right? Like, we're not macro prognosticators at the high level necessarily. But we do think that it's more likely and that it requires incremental moves to the portfolio. We're not going to put some gigantic hedge on or anything like that. It just doesn't really work at our scale. At the same time, like more germane to my particular position, I need to really think very hard about what types of strategies will do well when and if the regime changes, because it's not going to be the same people that did really well in the last decade, right? And so if I put together a portfolio that looks amazing on some backward-looking optimization, you got to stop and say, well, look, is this really going to work? Kind of like 10 years ago when everybody was still piled into some managers, as I was saying earlier, that did really well in the last cycle and weren't future-proofed. So that has absolutely gone into our decision making and our hiring dollars in the ground in my portfolio in the last year, 100%. Right. And we'll continue to think about it. Here's the challenging part, though. The advantage is to the smaller allocators out there who can make allocations to more niche strategies, because commodities, for all of their diversification properties, a lot of times can be not very liquid in some areas that you might want exposure to. And so if you're a larger allocator like us, you need to think very creatively on how to access, some of the other markets. Like I said, systematic works for us because it's easier to put more money to work there if someone's covering a lot of markets. But, there's certainly benefit to thinking of creative structures to accessing smaller opportunities. I keep a list of things that I had to pass on because we're too big, and half that stuff is capacity constrained commodity strategies.
Yeah, no, you make a great point there, and Mark also touched on that a little bit. It's certainly something that we at Titan Advisors think about. When we invest in the space, we love these smaller capacity constrained managers that can access niche markets where there's some real alpha to be generated. So Mark, just given that fact that from the poll, it certainly sounds like a lot of people are on the fence, and given pension funds seem to still be underinvested and concerned about inflation and potentially using commodities as a way to get around that, it's obviously potentially a catalyst for another big move higher. What do you say to investors who come to you and say, I'm thinking about investing in commodities, but have I missed the easy money and have I missed, the bulk of this move? What do you say to people like, well, how should they be thinking about where we are in the cycle and what to do?
That's a great question. I think Tim sort of hit the nail on the head when he showed the kind of longer term cycle charts. I think that those make a lot of sense. So I always say no. This is the start of in my humble opinion, a long cycle. And then just from how to access it, I usually tell folks to do both active and become plus. And one thing I didn't mention earlier when I was trying to answer the question about how we invest in hedge funds is on the long only side, I look for long only managers that really employ almost like a hedge fund strategy over the BCOM. So I get a lot of active management. I think that's the best way to do it, long and short, to Tim's point. But so are we, at the end of it, or is it the beginning? And I think it's a very complicated question. I apologize to everyone on the phone who's like a commodities practitioner, but I just wanted to spend like a couple minutes on some numbers because I think it paints a very good picture. And so here we go. I'll try to get through this quickly. If you look at research, you'll see very quickly that over the next, call it 20 years, pretty much anyone that puts pen to paper comes out with $100 trillion required to achieve sustainability and climate neutrality. So this group called Global Infrastructure Hub, it's funded by the UK, Australia, Canada, Germany, all these different countries. They come out at about $3 trillion a year this year, ramping up to $4 trillion by 31, and then well past $5 trillion. So this is obviously a long-term forecast, but when you start looking at what's involved and what projects are already underway, you start to gain confidence that these figures aren't complete baloney. I think that's the point. So starting with industrial energy use by type, it's clear that we'll start to need a lot more electrification. I think it's obviously impossible to do with burning coal and oil and natural gas even. A lot of that's being done on site to provide power. And in my lifetime, we actually haven't increased electrification of industry in America because it's been just so much cheaper to burn natural gas on site, for example. So now putting some numbers in to change the situation will require something like 100,000 gigawatt miles of transmission lines in the next 10 years alone in the U.S., which is 50% more transmission lines than we have now. So you got to think about what's the commodity intensity of getting that stuff done. What's it going to cost? And right now, getting pretty much anything done is impossible because of the NIMBY or the environmental concerns. So, and then in the next 10 years, it's another 180,000 gigawatts of transmission lines. And so these numbers are from the DOE and some Princeton research from 2020. So the expectation is that the power that goes through these lines will be green, solar and wind. And to generate that, DOE and Princeton again are looking at, going from 250 gigawatt hours of wind and solar capacity in the US to something like a terawatt of combined wind and solar capacity in the next, call it 8 to 10 years. So, so there's that. And then you've got this 20 to 40% of new vehicles needing to be EVs by 2030. This is all JP Morgan IEA data. Again, apologies to everybody who already knows this. But so between the cars and the energy storage needs, in the wind and solar solution, that's a lot of batteries. In fact, about 1.7 terawatt hours of demand by 25, up from 300 gigawatt hours of battery demand today. So 5 to 6 times as much. And now here's where it becomes a little more tangible because all of these numbers are huge. And like I said before, like my argument is that people want it. They don't want to pay for it. They want politicians to push it forward, but nobody really understands the minutia. So I happen to lean pretty hard on Rystad research. I find Rystad to be the global gold standard in asset level energy research. They have sent me a lot of data on, Tesla, CATL in China, Panasonic, LG Chem, Volkswagen. Collectively, they have literal programs underway to satisfy these battery demand figures. Mm-hmm. And so, okay, that's great. Now, the last thing I'll say is a figure that's very tangible is right now we produce 2.5 million tons of nickel a year, which mostly goes into stainless, right? By 28, it looks like we could need another 2 million tons a year for these batteries.
Yeah, the numbers are staggering. We've gotten a lot of data from one of the metals managers as well, and it's just to your point, it's really staggering. Just in the interest of time, guys, I got a couple of questions, and I just want a quick poll for the three of you. This one's for you, Tim. I got a question here from one of the attendees. If CTAs weren't perceived as being long vol, would people still invest in them?
Yeah, I mean, there's lots of perceptions on that. Would people invest in them? It's a tough one. I mean, look, CTAs and our approach isn't some panacea by any stretch, and I think what we have to highlight is times that we're going to perform, and perhaps as an individual manager when you're going to outperform because of your particular edge or tilt. And I think that long vol perception is out there. But I guess at the end of the day, we're part of the pie, right? I think we're a valuable part of the pie. This sector, I think that's fairly well understood by sophisticated investors. It is a little more complicated. Maybe it scares people because it's futures based. It depends. But at the end of the day, I think what we can recognize is this is an area that's been around a long time. We can see when it sort of performs a little bit better than other times. And now what I love about some of these discussions is people are getting, breaking down CTAs. We're not all in one camp. And so that's probably what my takeaway comment is, don't put CTAs all in one camp. I come from a very different background as a CTA than, the Turtle Camp and the London Group. My path to becoming a CTA through a conservative Canadian bank and an energy major is a very different path to systematic trading. And so, I think there's something for everybody out there. You just got to know what you're looking for, and hopefully you can find what you need.
Great, thank you. All right, I got one question. Maybe Stephen, this is a good one for you, and then I got a quick question for all of you. So would investors benefit from the ability to get exposure to specific physical assets via digital tokens that exist on a secure blockchain-based platform? That's from one of the attendees.
That's a very complicated, detailed digital asset question. I can tell you what I think about digital assets in general, but I'm not so much of a crypto head that I can actually understand what they're asking me. Look, I think they're an interesting trading class. I think that, if one of my managers comes to me and says, I want to trade this long and short, I'm fine. I'm not sold on the long-term case as some kind of like inflation hedge or, this thing's going to take over the economy, or we're all going to be transacting in Ethereum in 20 years in our flying cars and space helmets. I mean, the one thing that I have seen that like really links it to the real financial economy is it's positively correlated with emerging market stress. So, whenever you can't get your money out of a closed economy, it's a good alternative. I think there's enough liquidity there to make it a legitimate trading class, but I'm going to wait and see on actually being long it in some kind of systematic fashion. And I know we probably don't have time. Tim's got a lot of thoughts on this, but I think we're kind of in the same camp for the most part. But
look, at the end of the day, we're looking for things that are accretive to the portfolio. And at the end of the day, if the liquidity is there and we don't feel there's an enormous amount of gap risk, we can manage our risk on an overnight basis, then it fits the criteria. And for example, Bitcoin futures do fit that criteria. However, to the point that's been made a couple times in this session, we have encountered investors that aren't there and don't want us to be in that space. So, we're seeing all sides. One other part of this question was, for CTAs and role risk and this operational aspect because we trade futures. The one thing I want people to think about is the fact that we have to roll futures contracts is not necessarily a negative thing. There's a lot of value in the term structure, and I alluded to this earlier. So I don't think people should be scared of that. It's maybe something that is abstract for many investors who haven't been in the futures space. But if you've been in the term structure space, especially in the energy world, the term structure and rolling futures contracts can be very much an edge. And it shouldn't be something that you're worried too much about if it's done properly.
Well, it looks like we're out of time. So I got one last question for each of you. And when we think about underinvestment, and we know a copper mine takes anywhere from sort of 5 to 10 years to get production back up to speed. I'm not pointing in any direction in terms of my preference, but each one of you, which commodity is going to perform the best over the next year?
I guarantee you, whatever you hear on this,
everyone's getting out their Interactive Brokers trading account right now.
We'll give you the three that are definitely not going to be the best. I don't think anybody.
I want the best ones.
I'm just going to blanket industrial metal space. That's a cop out.
Industrial metal space. And Tim, I know you're agnostic, but which one's going to?
Yeah, I'm agnostic, and this is going to be a biased answer. It's going to make me look non-agnostic, but I think energy is going a lot higher, and I don't see as much downside risk. I came into this year and it was at $60 and thinking that's as far as it was going to get, in my view, and I think we're going quite a bit higher for lots of reasons. I think the grains market is going higher, for sure. And I think that, picking on the metal space, industrial, I think if you just look at the amount of copper use and the needs, I think it's headed a lot higher as well. So I'm just going to pick some classic ones, not to be too obscure.
Okay. Well, they're certainly a lot cheaper to own longer term now than they were a year ago and 2 years ago for sure. So that sounds like it's a pretty bullish case overall. I just want to, wrap it up now. Meg, I know Meg just came back on there.
Graham. So that was, I don't even know where the hour went, you guys, that we had so much information. The research was incredibly, I think you really gave our audience an amazing amount to think about. So I want to thank you so much. Stephen Wilson, I think you just won the award for the best laugh. That was just a great belly laugh. Right. And we haven't had a good one like that in a long time. And you guys also happen to set us up for next week's webinar, which does happen to be on cryptocurrencies. So well done. I don't think you even really realized that. But I want to thank you for your opinions and your candid comments. Just an amazing session. And hopefully we'll be able to get that video out to the people who couldn't make it. We had a huge crowd today. And so thank you all for tuning in. Everybody have a great weekend. Herman?
There was a ton of research that these guys put out, and I was fortunate enough to read some of it. Are the attendees able to get that research, for example? I think
sure, they can contact me. You can probably get Tim's slides. We can probably extract something from Mark. We'll try to do that, and maybe we'll revisit this in a few months and see how things are really shaping up. That could be very cool. We're going to be in Austin, Stephen. We just signed a contract for March 16th. So get ready. The industry's coming down to see all of you asset owners down in Texas.
You're all welcome.
Thank you so much. We're looking forward to it. And Herman, thank you so much for taking over the moderating position at the last moment. We had Jackie Rosner, who had to bow out at the last moment. He had a death in the family. And Herman jumped right in. Very, very gentlemanly and elegant of you. Thank you so much.
Thank you for allowing me to moderate. Meg, there were a couple of questions, maybe we can get
that
back
we didn't
to those,
get to.
A couple of good questions that I was unable to get to because we ran out of time. But maybe we can copy those down and get those answers to those folks because they were good questions.
We will get the questions out to all of you, and then we can talk about how to answer them so that our audience knows that the answers will be forthcoming. So again, thank you everyone for joining us and have a great weekend.